The double entry system. With the double entry system, 2 entries are made for each transaction. It records changes in values of assets and liabilities as well as revenues and expenses. There are equal and offsetting entries for every transaction. It requires more effort, but it's also more accurate. So in essence, we know that all our debits must equal all our credits. The balance sheet. The principal accounting equation that we know are assets equals liabilities plus owner's equity. Assets are items of value, tangible or financial. Assets are the resources owned by a business. Examples include cash, equipment, machinery, land, bank accounts, buildings, grain, livestock, etc. Liabilities are debts or other financial obligations that must be paid at some point in the future. Examples include accounts payable, notes payable, salaries payable, interest payable, current portion of long-term debt, taxes payable, etc. The difference between business assets and business liabilities is owner's equity. It represents the net value of the business to the owners of the business. Owner's equity is what remains after selling all assets and paying all liabilities. It's what belongs to the owner after all assets are sold and all liabilities are paid. It's the ownership claim on total assets. So the basic form of an account is the T account. We have our left or debit side and our right or credit side. At the very bottom, you put the balance. So if it's a debit account, it should have a debit balance. And if it's a credit account, it should always have a credit balance. For example, assets are usually a debit account, so increases in assets are represented by a debit to the asset account. A decrease in assets would be a credit. So the normal balance of an asset would definitely be a debit account. Liabilities, on the other hand, are, as we know, they're on the other side of the basic accounting equation, and therefore they are credit accounts. So their normal balance would be on the credit side. Liabilities are represented by a credit, or an increase is represented by a credit, and a decrease is represented by a debit to the account. Liabilities and owner's capital have both the same credit balance. Increases are represented by credits, decreases are represented by debits. Owner's drawings, on the other hand, is contrary to owner's capital. If an owner draws on their account, an increase in this account would be denoted by a debit, and a decrease by a credit. So owner's drawings has a normal balance of a debit. Revenues and expenses. A revenue is the value of products and services produced by a business during an accounting period. Revenue can be cash or non-cash. Revenues increase owner's equity. As a result, they're recorded by credits. So when you think of revenues, think of owner's equity, and always go back to the basic accounting equation. So the normal balance is a credit. Credits represents increases in revenues, and debits represents decreases in revenues. Expenses, on the other hand, are exactly the opposite. Expenses decrease owner's equity, and as a result are recorded by debits. So an expense account has a normal balance, has a normal debit balance. So debits increase the expense accounts, and credits decrease the expense account. So here we have, in summary, a debit is an accounting entry on the left-hand side of a double entry ledger. And as we heard before, it doesn't necessarily mean a positive or an increase. It depends on the type of account and on which hand side of the basic accounting equation you're working with. So a debit represents an increase in an asset account, a decrease in liability, a decrease in owner's capital, an increase in owner's drawing, a decrease in revenue, and an increase in an expense account. A credit, on the other hand, is an entry on the right-hand side of the double entry ledger. The credit records a decrease in an asset account, an increase in a liability account, an increase in owner's capital, a decrease in owner's drawing, an increase in a revenue account, and a decrease in an expense account. This is exercise 3. John White opens his consulting office on July 1st, 2012. During the first month of operations, the following transactions occurred. Prepare a tabular summary of the transactions. So the first event, he invested $10,000 in cash in the consulting office. So this event will increase cash by $10,000 and it will increase owner's equity by $10,000. This would be an investment. The second transaction is he paid $800 for July rent on office space. So rent expense will decrease cash by $800 and it will also decrease owner's equity by $800. And this is rent expense. The third transaction is he purchased office equipment on account for $3,000. On account means that this will affect our accounts payable. So number 3 would be office equipment plus $3,000, and our accounts payable will also increase by $3,000. Number 4, he rendered services to clients for cash for a total of $1,500. Since it was for cash, he increases his cash by $1,500 and he also increases his capital by $1,500. And this is service revenue. Okay, so we have transaction number 5. He borrowed $700 cash from a bank on a note payable. So that $700 will increase his cash by $700, but it will also increase his notes payable by $700. Number 6, services rendered to client on account, $2,000 total. Since it was on account, this means that the client still hasn't paid up. So this one will affect the accounts receivable account, and it will increase it by $2,000, and it will also increase John White's capital by $2,000. This is service revenue. So transaction number 7, he paid a monthly salary expense of $500. So that would decrease cash by $500, and it will decrease John White's capital by $500. And this would be a salary expense. Number 8, he paid monthly utilities expense $300, so that will decrease cash by $300, and it will decrease his capital by $300. This would be a utility expense. And number 9, he paid a monthly telephone expense of $100. That will decrease cash by $100, and it will decrease his capital by $100, and that would fall under telephone expense. Notice here that for every transaction that happens on the left-hand side of the equation is also mirrored by transactions happening on the right-hand side. So now what we do is we add all of these and put the total at the bottom. So for cash, the total will be $10,500. For accounts receivable, we have a positive account of $2,000. Office equipment of $3,000. And this is equal, or should be equal, to the sum of everything else, which is $700 plus $3,000 plus $11,800. And that is basically your balance sheet. $15,500 on your left hand side and on your right hand side.